Hey guys, welcome to another great video on our channel. Investing in real estate is one of the safest and oldest forms of investments there ever were. But the common belief is that you're going to need a large capital just to step foot in the real estate business. Well, that might not be completely true because, as they say, where there's a will, there's a way. So let's look at how to buy real estate with no money down. Number 8. The meaning of no money down. When we say no money down, it doesn't mean that there won't be a payment at all. It just means that the buyer won't have to pay anything out of their own pockets for the down payment. Borrowing money from a lending institution is one of the ways to make this process happen. In most cases, in a typical real estate negotiation, you would buy a house with a 20% down payment and finance the rest with a mortgage. Unfortunately, not all property sellers accept mortgage debt. Credit union properties, for example, require an all offer with no mortgages accepted. The key to comprehending no cash down real estate is to realize that properties under the ownership of a bank frequently sell at a discounted price to current market price since they require a cash user and don't allow mortgage loans. Number 7. Private lending institutions. You can obtain funds from a lending institution if you don't have the money to compensate for a house that is owned by the bank. Loan providers vary substantially from traditional lenders in that they're more concerned with the purchase price of the property rather than the consumer's creditworthiness. Assume you've discovered a $1 million US bank-owned estate that you might buy for $800,000 in cash. This equates to an 80 cents on the dollar purchase price. For this property to appraise at its full market worth of $1 million, it will require at least $100,000 in renovations. An investor might be willing to buy the house, remodeling it, and then reselling it for a return. That is one approach. However, there's one more technique that has the potential to be even more profitable. Suppose you were able to find a private lender who would lend you over $750,000 US of the $800,000 buying price. Their insurance is the estate, and since the net present value is positive $1 million after repairs, lending you $750,000 and earning a high rate of interest is not a terribly hazardous deal for them. Number 6. Buying the estate. Your first move would be to somehow arrange for the $50,000 which you're going to need after you borrowed $750 from a lending institution. There'll be other expenses as well that you'll have to cover, like points and fees or closing costs. The money that you've spent out of your pocket so far would be a little more than $50,000. Number 5. Remodeling and renting the property. Once the house has been purchased, the ideal move would be to hire someone to do the renovation of the house. The money will have to be paid out of your pocket for this purpose. Once we paid $100,000 for the repair of the property, its net worth increases. We will not have to remodel the entire house either. It is, however, essential to cover the bathrooms, paint, tilings, and the living room area. After the renovation process, the next move is to rent the property to a suitable tenant. You can get up to $10,000 in rent income every month by doing this. Number 4. Refinance the loan. The next move is to renew your debt once you've found a tenancy agreement. Your financial advisor will arrange an assessment, and if your estimates are completely accurate, the estate should analyze and evaluate for at least $200,000 according to your calculations. Because everything inside the property is spanking new, your evaluation may be greater than you expected. The bank is willing to lend you 80% of the appraised worth of $1 million. This is worth $800,000. The bank will charge an extra fee to renew this loan. You'll be left with almost $800,000 after interest charges. The bank will repay the private lender for the $750,000 loan and give you the remaining $50,000 in cash. As a result, you now acquire a $1 million investment estate with an $800,000 mortgage and a $50,000 capital stake in the property. You've made a $50,000 boost in your personal wealth. The $50,000 you put into the residence to buy and refurbish it is now back in your bank account. You've effectively bought a home with almost no money down. You would have incurred some costs along the road, such as interest, homeowner's insurance, and taxes. However, the property's first, last, and security deposits will cover these costs. This method can be used to purchase your second, third, and fourth real estate businesses. You can possess up to 10 affordable housing units in your own name under current legislation. This is one of the simplest methods for accumulating wealth. All that is required of you is that you have employment and that you have good credit. With interest rates at historic lows, now is an excellent moment to use this investment technique. Number 3, hard money lenders and wholesaling. Hard money lenders, unlike private financial institutions, charge payment in the form of points. These points, which average from 3 to 5, indicate an additional advance percentage fee based on the debt outstanding. This is in addition to the interest rates charged by hard money lenders, which range from 10 to 18%. Investors must conduct due research on hard or private money lenders because fees and lending rates are not uniform. Wholesaling, as an introduction to investing in real estate, doesn't necessitate a good credit score or a hefty down payment. Instead, having the appropriate numbers in place is all that is required. Finding cheap houses, assigning the contract to a prospective investor, and getting paid for it is the essence of commercial mortgage wholesaling. Number 2, partnerships. Alliances are a frequent way to get into real estate investing. The use of alliances is a common method in real estate transactions. As an investor, if you miss something, another individual can compensate for it. In many partnerships, one member may locate a foreclosed home at a reduced price while the other may finance it using their credit score and working money. Simply ensure that everyone contributes something to the meal. Targets, risk, responsibilities, and profit should always be reviewed before forming any type of partnership, especially for more active traders. Number 1, renting out the spare or house hacking. As the name implies, house hacking is a commercial mortgage method that allows experienced investors to profit from a distinct set of circumstances. This evacuation option, on the other hand, will see investors receive rental income by letting out their personal residence. Those who own multi-unit properties, for example, may decide to rent out the units they don't use. As a result, the rent collected may be used to help pay off the mortgage, essentially allowing the homeowner to live without a mortgage. Those who live in single-family residences, on the other hand, may choose to rent out rooms when they have the opportunity. In either case, home hacking allows investors to reduce the risk of vacancy while simultaneously increasing their cash flow. Another good way of arranging finances is through government loans that are granted to the real estate investors to promote local business activity. USDA or VA loans are good options that can get your foot in the door, especially if you have a very small amount of money or no money at all. If you guys can contribute to this list, then do let us know in the comments down below, and I'll catch you guys later in another video. Bye now!